Mortgage rates are still under pressure this week, and jobless claims did not give the bond market much relief. I'm Cathy Sabater, and this is your Thursday Market Watch. This week, three forces are keeping pressure on mortgage rates. First, jobless claims came in 213,000, which was lower than expected. That tells the market that layoffs are still relatively contained, which makes it harder for bonds to price in a fast mortgage relief. Second, inflation is still part of the story. Yesterday's CPI report showed that inflation is running about 2.4% year over year, and the Feds want it to be at 2%. That keeps the market focused on whether inflation is cooling enough to allow lower rates. Third, oil and geopolitics. Oil prices jumped sharply as the Iran-related conflict, along with the disruption fears of the Strait of Hormuz that provides 20% of the world oil supply. When energy prices rise, inflation fears usually rise with them. Then that tends to keep pressure on treasury yields and mortgage pricing. Here's what it means for buyers. Bank rates average of a 30-year fix this week is around 6.19%, up from last week. A buyer financing a $700,000 loan today versus last Thursday is paying approximately $54 more per month in principal and interest alone. Over 30 years, that's nearly $19,600 in added cost to keep the same payment. That payment could potentially lose around $8,900 in buying power. For sellers, tighter affordability means buyers become more payment sensitive, so expect more conversations around seller credits and rate buydowns. For move-up buyers, equity still creates options, but the math has to be tight. That's where structure matters most. Bottom line, the mortgage rates are still pushing around by the labor strength, inflation pressure, and oil-driven fear. So this weekend, don't guess. Run the numbers. I'm Cathy Sabater. I'll see you next week.